Ralph Lauren topped estimates for revenue and adjusted earnings per share in its fiscal fourth quarter. But as tariffs take effect, the luxury retailer predicts sales growth will slow in the latter half of its fiscal year. LVMH has reportedly been warning investors of continued weakness in demand. That's according to reporting from Bloomberg. Joining me now to put it all together, Pauline Brown, former LVMH chairman of North America. Pauline, as always, it is great to see you. We've really seen interesting indications from some of the big luxury houses or sort of mid-market to luxury houses. I think of Tapestry as well, which did better than estimated. Big picture, how are you viewing some of these tea leaves that we're getting?
So if there were two themes that define the current market of, as you said, either moderately luxurious or ultra luxurious brands, it's the winners are those that are perceived as good value and those that are purely luxury lifestyle. So what do I mean by that? Ralph Lauren came out today, really had stellar results. I have to say, I mean, up high teens in China. I mean, nobody's growing like that in China. But I think the story there that really wasn't told directly is that this is a trading down. Ralph Lauren has almost 200 outlets in North America alone. I mean, discount outlet stores. Prada, by comparison, which is also doing well, has less than 10. Armani has closer to 15. So there's a big portion of Ralph Lauren's sales that are not happening at the purple label level. But the cachet of the brand is still bolstered by that purple label. So Tapestry would fall into a similar camp as Ralph, and they are doing very well. And then you have a few players like Hermes, and Brunello Cucinelli and Moncler that are more lifestyle than fashion, that are also more purely luxury than spanning all the different segments, and that are not that diversified like LVMH and Kering. And in this case, that's a good thing. They're also doing very well, the ones that are less diversified.
When I see, the trends in Ralph Lauren, there's a few questions from where things are produced, where they're being, consumed. It's interesting that North America revenue looked only up like 3%, but Europe up double digits, China up double digits. China's been one of those interesting markets where you see they're competing in things like EV and phones with Huawei, but the branding on luxury items like this, they've got some things like Anta, who's making progress on some parts of clothing, but what do you think about the luxury brands in China? Are they going to be able to compete with their own brands here in China versus like a Ralph Lauren?
So if the question is, do I think Chinese marketed brands are on par? Absolutely not. Not to say that there isn't a lot of talent in China, not to say that the production capabilities aren't very good in China. In fact, many of the luxury brands are already making products in China. In the case of Ralph Lauren, about 15% of their supplies come from there. But the storytelling and the experiential design is not at a world-class standard yet. Why do I think Ralph Lauren, though, had so much momentum in a market that otherwise is treating most of these global luxury brands pretty harshly? I think because it's good value. And I think in an environment where the other brands have really taken price to an untenable level, there is an embrace of those that are still doing quality product and telling good stories and offering good experiences and affordable.
You mentioned earlier, Pauline, that we are seeing a little bit of a trade down effect. And it's interesting because I think we tend to think of the ultra luxury consumer as, unassailable, right? That they're going to spend no matter what. But what are the nuances within that might cause a sort of trade down effect?
Well, first of all, the real trade down activity is not that ultra affluent consumer that we're talking about, that top 0.01%. You're right, their behavior doesn't change radically. If anything, they're moving more and more away from the middle and more purely to the Loro Pianas and Hermes of the world. But the majority of the market is what we call aspirational. And that aspirational segment is price sensitive. And so I think for those brands that have made a good case by creating nice store environments, you'll notice in case of Ralph that their growth was largely driven by direct to consumer, the wholesale, where they can't tell their story quite as richly, that is not doing so well. But where they are, executing well, the customer, and I'm talking about this more mainstream affluent, but not ultra affluent customers responding really positively.
And of course, some of these aspirational brands are still getting to consumers through department stores, even if that is maybe a waning channel. We've got Nordstrom going private. We're going to hear from Macy's, which of course also owns Bloomingdale's, next week when it reports. What's the role of the department store at this point?
Well, it's been a weakening channel for decades now. And I'd say that's even more acutely the case at the high end than in the moderate price. And what you have seen at every level of luxury is their move more and more to opening their own standalone stores. The reason, though, that some of these more capable department stores are not going away, they may continue to erode, but they'll be here for a good while, is because the consumer still wants a multi-brand shopping environment. There are very, very few consumers who will go into a standalone store and say I want everything head to toe, from the perfume to the shoes to the bag to the dress. Most of us shop in a way that's more reflective of our closets. And so the idea of a multi-brand store is still something that is in keeping with the way consumers want to shop, but the delivery of that multi-brand proposition has become very challenging. I would also argue that multi-brand retailers like Macy's have just gotten so large and so expansive that they've almost over-assorted for that same customer. The ones that are really winning right now are more curated.
Pauline, one of the things, when you think about the retail and consumer, I think one of the interesting stocks recently has been Walmart. It's sort of the opposite, you could say, maybe of just this luxury brand. But Walmart, when I look at the valuations, selling at a PE higher than Amazon. Amazon being viewed as this, not just the retailer, but the tech side of things. Anything you're seeing in sort of Walmart versus Target in the sort of general consumer where they're going shopping?
Yeah, I mean, I think Target, as has been, I think, become increasingly evident, has lost its way. So Target could never compete with Walmart on scale and on resources. But for a long part of its history, it was competing on brand, on store experience, and on values. And I think, most recently that store's retrenchment away from a set of values that came to define a more progressive store and a more progressive culture has backfired. So if you're just going to play on price, game over. Walmart wins in terms of the bricks and mortar world. But if you're playing on a combination of price in conjunction with another set of experiences and connections with the customer, then that Target still had a play. So I think Walmart here is a beneficiary of some of Target's issues. And I could say the same about Kohl's as well. Kohl's, JCPenney, many of those that had been chipping away at Walmart for a number of years are now quite a bit weaker at leaving the space wide open for an already very strong player, which is Walmart.
Pauline, always good to see you. Thanks so much for joining us.
Thank you.